Hello everyone, George DeSantis here with the look at the market for the week ending September 16th, 2016. I'll read the disclaimer before we go further. Trading and investing has large potential rewards and large potential risks. So this video presentation is designed for educational purposes only and is not a solicitation or advice to buy or sell any securities or other tradable instruments. You must be aware of the risks and be willing to accept them in order to invest in the markets. So consult a licensed professional investment advisor for investment advice. This is not investment advice. Let's begin by taking a look at the monthly chart of the S&P 500. And here's the monthly chart of the S&P 500. As usual, nothing really changes very quickly on this chart because each bar represents a whole month's data. So we can see the Kalman filter is still above the instantaneous trend line, of course. The instantaneous trend line is trending up, which is bullish. The parabolic is below the most recent bar, this month's bar. So there's no indication to reverse the uptrend. And MACD is just hugging the zero line, so we are at minus 1.05 on MACD. So there's a real tug of war between the bulls and the bears at this point. And at the bottom of the chart, Elder Force is still above the zero line, but trending down a bit. So nothing much has changed here on the monthly chart. Let's take a look at the weekly chart. On the weekly chart of the S&P 500, what we find is that as I discussed like a couple of weeks now, the Kalman filter and price of S&P became pretty overbought. In other words, it moved so far away from the instantaneous trend line. And as I mentioned, just as Alex might talk about the consensus of value being between a 10 and a 20-day moving average, we could consider the instantaneous trend line the consensus of value here. So what really took place? We had a movement away from the consensus of value. It became overbought. We had a consolidation period. This was an inside bar or harami, but it didn't materialize as a signal for an uptrend for further move up. And now, and 2 weeks later, we had this bearish engulfing candle. Last week, though, we came all the way down to sit right at the low sat right at the instantaneous trend line. And now we have an upside down hammer. And although the classic definition of an upside down hammer would be that this shadow should be twice the length of this body. It's not quite there. It really isn't, but it's beginning to look more like a hammer, like an upside down hammer. So we'll see. The big question is if we can hold at this support level, if in fact the instantaneous trend line will hold a support as it did previously at this level back in June, July. So the big question is, will this hold a support? That'll be determined next week or two. So let's take a look lower down. We find that RSI 12 came down close to the 50% line and trended up a little bit last week. So that's good. The trend is still up. MACD, the slow average crossed below the fast average crossed below the slow average. So we're now in a little bit of negative territory, minus 2.67. We don't have a divergence, so it is not as significant a move here as if there was let's say, a bearish divergence. Below, at the bottom here, we have percent R still hovering around the 80% level. So the momentum is still pretty strong. So all in all, the uptrend is still in place. And we're at a critical juncture here where we wait to see if the instantaneous trend line will hold as support for price. We're just sitting at that. The low is sitting right at that level here at the instantaneous trend line. So let's take a look at the daily chart. Here's a daily chart of the S&P 500. And as we discussed before, once that 9 EMA crossed below the 30 weighted moving average, which is the yellow line crossing below the blue line. Market came all the way down and seemed to have found support at 2120. Right here, we can see that it hit the 2120 mark here. The next day it hit it again. The next day the low sat right at it. And then on Thursday and Friday, we had a bit of a trend up. Okay, so we just had a little interruption with my doorbell. However, I was saying that we have um, an ABCD triangle now, and I calculated a target of 2192 for the triangle. And you can see how I did it here. The high of at A minus the low at B plus the level at E, the high at this bar, and we get a target of 2192. Now that's pretty close to 2200, which we calculated on a previous triangle sometime back, and we'll see if we get there. Then again, we have RSI below here is still hovering around 40%. It broke above 40%, came back below it. It is just oscillating there as the price oscillates at this level here. But it does seem like if this market is seeking a bottom at around 2120, we'll see if that really holds. Now, Williams' pro-buying indicator is also just hovering around the 0% line, and percent R is likewise in the low level here, just above the 20% line. So the conclusion here is that on the daily chart of the S&P, we seem to have completed a downtrend. We seem to have found some support at 2120. We're going to see if we can get to make this move up to a target of 2192 or the 2200 that we calculated earlier. And that all depends on how this develops. Now, another thing I've noticed here is we do have a morning star formation. We have a very bearish candle, we have a doji, and we have a bullish candle here. So this is a bullish morning star. That augurs well for the future in terms of the bulls, so far as the bulls are concerned. My contention is that I think we're going to go higher. We might see some further consolidation in the next day or two, but we'll probably go up higher from here and hold at 2120. Okay, let's take a look at another chart. Here's another view of a weekly chart of the S&P 500, and I just want to show you what CCI is doing at the bottom here, because since we crossed over the zero line here, CCI has remained above the zero line. I did got rid of half of my position here and sold another half, so I did get rid of it. I sold it, but I'll be looking to buy it back if we have a zero line reject, as we did here. This is called a zero line reject. Comes down to zero line and the zero line rejects it. So I'm anticipating something like that to re-enter with another holding of SSO. I have some of SSO in a portfolio of ETFs anyway, but I would like to add to it if that happens, if we get a zero line reject. So as we can see up here, it's the same weekly chart, so we see that bar sitting right at the instantaneous trend line. Let's take a look at a different chart. Here's the weekly chart of the NASDAQ composite, and this is an interesting chart. First of all, we see that since Kalman filter crossed above the instantaneous trend line, it tested it twice. And for some weeks now, I've been saying, wow, this market is topping out here. And it still looks as though it might be doing that, because we had a couple of dojis, like 3 or 4 of them. Then that was followed by a pretty big bearish engulfing candle. This body of the candle, red candle, totally engulfed this previous candle. And then last week, what we have is what is called a piercing candle, a very bullish candlestick. Probably most of that is accounted for some of the technology stocks that rallied, like Apple. And in any case, though, it's a pretty bullish candle. So what we see at the bottom of the chart here is that RSI 12 came down the previous week, and last week it bumped right back up again to cross above the 60% line. So we're still having an uptrend here. I mean, I don't see any reason why we should say otherwise. The parabolic is still below the most recent bar. And MACD is trending down a bit, but the slow line, this fast average is still above the slow average, and we don't have a divergence by any means. Now, the other thing is if the NASDAQ typically leads the rest of the market, this also looks well for the future for the market, insofar as a bullish scenario is concerned. So let's take a look at the daily chart. Now, on the daily chart of the NASDAQ, we can see that the instantaneous trend line was crossed by the Kalman filter here, and it remained below it for a while, and now it seems to be approaching it again to perhaps cross over it again, confirming the continuation of that uptrend. What I find here is that we had a very bullish candle here, and almost totally engulfing this previous candle, the body of this previous candle. Then we had a bullish harami. This body is inside this body. It's sometimes referred to as a pregnant woman. And then we had another harami followed by this bullish candle. At the top here, though, we have a little bit of a question with this bar. This bar may be a hanging man. We shouldn't be surprised to see a little bit of a pullback. Also, we're approaching the parabolic. So if the parabolic gets hit again, parabolic will go below the bar, and that would be bullish. So again, as we saw earlier on the weekly chart of the S&P, we are sitting at a critical point here. At the bottom of the chart here, we see that MACD is once again trending up from below the zero line. That's a good sign. That's a bullish sign. And further down at the bottom of the chart, the Jerry Appel's sum of the rate of change indicator had a false breakout, came down, and is now approaching the 4% line again. If it breaks above the 4% line and has some follow through, that would look well for the future, for the bullish scenario. So let's take a look at something else. We look at the weekly chart of the S&P with the impulse bars. Now, of course, we're interested in the last bar. The last bar is red. So S&P still looks to be to be retracing here to consensus of value. The 9 is still above the 30, but price is now closing between the 9 and the 30. So we wait to see if that consolidation that we've seen earlier continues, or if we begin to find support here. So let's take a look at the daily chart. Now on the daily chart, we can see an indication of that, perhaps that bottoming at 2120, because we now have an inside bar which is blue, and according to Alex with the impulse indicator, when we have a blue bar, we're allowed to go long or short. So this is a decision point here, and we wait now to see what direction this market will take. Let's take a look at another bar, at another chart. And lastly, this is the chart that shows us the percentage of stocks above the 200-day moving average for the S&P 100. And as we can see here, it is at 81%. And as long as we stay above that 65% level, we shouldn't experience much of a drawdown. So that's enough for this week. I'll talk to you next week again, and have a wonderful weekend.